Right, thanks. And we have a very difficult task at this moment in time because we have had two speeches which have not really been, what should I say, enervating or uplifting the spirit of people. Of course, we are all looking forward to the spirit that will come later after this. But and therefore, this panelists have a tough job to do of painting an optimistic picture. Hopefully, that's what they will do because they are. Even in adversity, they have delivered much better returns than most people do. Just going back to last year, we had Dr. Parthasarathy Shom, and we had, I would say, not a very, very different kind of talk. I mean, he disputed the figures that the finance minister had put out in terms of the buoyancy of the market, the revenue raising capability, the many other things and so on, and then it was followed by a panel discussion among panelists, and I think the mood was much better in the panel discussion. And if I were to look at the GDP, I mean the Sensex, which was I believe around 23,000 at that point in time, to about 28,300 or so that we have it today. The fund managers and the analysts seem to have done a far better job of reading the economy or reading. One of the questions that I asked as I was sitting in the audience and I decided to ask a question, and the question that I asked was, what would happen if Brexit and or Donald Trump becomes the president? I was, it was cursorily dismissed, that question, because they said that both these are not going to happen. Brexit did not happen, so Brexit will not happen, and Donald Trump has absolutely no chance of getting elected. And both those things have happened. Dow has gone up, and there is still a reasonable amount of optimism everywhere and so on. So I don't think we can take some of these essential, simple things into and say that this is what is going to happen. The fund people who are managing funds, people who are analyzing in the equity market have done far better job. So that's where I'm going to conclude with my own opening remark. I'm sure there are a few more positives, and I haven't briefed the panelists, but I'm going to ask each of them to make some opening statement as to how they find this budget, and what are the one or two essential characteristics which they think is really going to drive the market negatively or positively is there in their view, and how do they expect the economy and certainly the capital market and the equity market to behave in the next 1 year. So will I start with Prashant first?
Thanks, and very good evening to all of you. I think the budget was a very simple document to my mind, and first time in my career when I could leave office by 7:30. And I liked it for its simplicity, for a no-nonsense approach. I think this government is increasing continuously the capital expenditure, and they are curtailing the subsidies part, which are probably less productive. They are targeting subsidies better. And I think lower fiscal deficit improves the sustainability of growth, because it leads to lower interest rates, and which is a key factor leading to higher capital expenditure. I think private capital expenditure is not reviving for very simple reasons, but they are not related to the budget. If you look at the last cycle, power generation was a leading sector. We are surplus in power generation. In infrastructure sector, which was opened up to private capital for the first time, those businesses have failed, and most are in various degrees of difficulty. So it is unlikely that private capital will come into the same areas in the near future again.
The metal sector, which face very low commodity prices, is again beset with problems. So I think we should not link the lack of private capital expenditure to any policy or to budget policies in the budget. I think overall the economy is moving in the right direction, and I think whether you look at fiscal deficit, current account deficit, FDI, inflation, interest rates, we are progressing, and I am quite optimistic about the future. Coming to capital markets, it is noteworthy that India's market cap to GDP is nearly at all-time lows. For the last 9 years, the nominal GDP is up between 3 to 4 times, but index is up only 30%. Yes, in terms of PE multiples, the index does not appear to be so cheap because profitability in few sectors is very stressed, is at cyclical lows. But I think now there is evidence that over the next 2 years, we expect faster profit growth. And at such points of economic cycle, I think market cap to GDP is a more reliable indicator of capital markets than PE multiples.
So Mr. Chidambaram, whenever he read any budget speech, right since the 97 and later on, always ended the budget speech with a quote from Saint Thiruvalluvar. He didn't do it because he wasn't reading the budget speech, he was reading a critic. So I'll quote something from Saint Thiruvalluvar, that compassion, the most gracious of virtues, moves the world. So all the people associated with United Way, Chennai, the people who have contributed, and those who are using that contribution to help the sections of society, and they don't complain about what's not happening, but they rather take care of what we can do, and I think that they are really worthy of huge amount of praise. Thank you so much. On the budget, you look at the world today, and where in last couple of years since the global financial crisis, we have been experimenting with lower interest rate, then zero interest rate, then negative interest rate, forward guidance, quantitative easing, people talking about now helicopter money, and then now you are hearing about a fiscal expansion, right? I mean, Donald Trump is talking about it, maybe followed by several other countries. And you contrast that with India. Despite all the challenges that he talked about, you have a government which is saying that we will remain on the path of fiscal consolidation. You look at a monetary policy today, despite tremendous pressure, do you think RBI doesn't know that private capex is not happening? Do you think RBI doesn't know that consumption has slowed down a little bit? But moving on the path of keeping real rates positive so that we can win the war against inflation and inflationary expectations. I think these things will go a long way in creating a sustainable macroeconomic environment, which is most critical for any owner of any assets, whether you are holding equities or bonds or setting up a business. Nothing can be a positive news than this, where you have a government which is moving towards a path of creating a sustainable macroeconomic stability, a foundation on which a long-term growth can really happen without those bouts of challenges that we saw in 2008 and 13 recently and earlier. Now it's very easy to say that because there is a slowdown, government should increase the expenditure. But look at it this way, this year we'll be paying 5.25 lakh crore in interest payment. Why? Because we have accumulated so much of debt over the years. The debt to GDP is 68-69%. If you keep on doing it, and several other countries that have tried have got into trouble, if you keep on doing it, one day it will create bigger problem. And there is no point every single year you keep on saying that we will defer the target by a year because we have a challenge at the hand. I think containing the government deficit is one of the biggest positive of this budget. Similarly, when contrasting where the world is moving and where we are moving, you have a world where right from the Donald Trump and Brexit and other things, you have a world which is talking about anti-trade, anti-globalization, anti-immigration, more protectionist, and the gentleman asked about the FIPB dismantling. I think it's a big move. It's a whether you are relaxing the FDI norms, whether you are talking about ease of doing business and inviting more foreign competition, at a time when the world is becoming a lot more inward-looking and protectionist, is a great move. Over the years, I always mention that the government budget has to move from outlays to outcome. If you want to show your commitment to the rural economy, as you mentioned that fertilizer subsidy should have been increased, or payment to NREGA could have been increased, but you don't know what will be the outcome of that, because everybody knows the last mile delivery, everybody knows how much money really reaches the needy. I heard few good things in this budget. When he talked about the NREGA, he said 5 lakh ponds, and that too with geotagging. I think that's moving towards an outcome. When he talked about education, I think somewhere I heard learning-based outcome for colleges, on the University Grant Commission. While talking about healthcare, removal of TB by 2025 and one more disease by 2020. Of course, this is very small, but a beginning has been made. A small point I would make, India has been a very data poor country. My dear friend Nilkan keeps talking about it. India has been a very data poor country. Like in US, you get every first Friday of the month how many jobs that got created. Such a large economy, and you know that how many jobs got created in 1 month. Every week we have so many high frequency data. In India, we don't know what is our jobless rate. I'm sure the index of industrial production, one can discuss about it, how true it is to the ground. But now you look at this thing that we are actually leapfrogging, where the government said these many people bought cars, these many people traveled overseas, but they paid, or these many people are paying tax over 5 lakh rupees. Out of those many salaried class, these many people deposited that much of cash. I think this is just beginning. Geotagging of properties to ensure that all the properties are registered and you don't have a Benami property. I think this is just beginning, but with the Aadhaar card, which was one of the biggest contribution of Mr. Chidambaram's government, I think with the Aadhaar, with the digital technology, India can actually leapfrog, and one of our biggest challenges has been the last mile delivery, not having a proper analysis of various things. It can substantially improve. For example, the tax to GDP ratio can substantially improve when we have better data at hand, when we have better analytics at hand. The financial inclusion which is happening, the digitalization of finance can do a lot of good. So I think India is becoming a data-rich society. The government is investing in data, which is, I think, a very, very heartening feature. And I think from market's perspective, at the beginning of last year, as you rightly said, that had someone told, if you were an investor in United States and said that this year in 2016, Donald Trump will become US president, Brexit will happen, terrorist attack will happen in Germany, ISIS will continue the way they have been in Europe, the Chinese currency will go from 6.2 to 6.9, I can go on. One would have said, just go and short S&P, just go and short FTSE. The fact is, both those markets are record high. We must keep that in mind as we go forward in 2017. Thank you.
Thank you. Good evening, everyone, and thank you for inviting me for this. I'll start off with a comment on the union budget. I think, and I've been saying this for several years, the union budget is the most useless piece of document that I have seen, especially in the last 5-6 years. The role of the central government in the economy has shrunk dramatically in the last 25 years, but there is this obsession with Delhi which keeps us going after it. I jokingly asked a TV anchor last year when I was part of his panel as to why do you keep wasting people's time with this media circus around the budget, and he said, what do you expect us to do? This is the biggest TRP event for the year for us. If you look at the numbers, state budgets, the state government spend nearly 65% more than the center. Just the state of Uttar Pradesh spends 20% as much as the center spends. If you look at the amount of discretion that the finance minister has, I mean, we can criticize him to death, but out of 21 lakh crores of the budget, I don't think there is more than 40-50,000 crores that he can really have some discretion over. Once you've done away with, as Navneet said, the interest payments, the salary payments, the defense expenditure, you and I may think subsidies are discretionary. They're not. There's not too much discretion he has. The real fun is when you analyze state budgets. And I think there is phenomenal activity happening at the state government level. You have to go through the details of what each state government is doing, and that's where I think true reform is happening, which is why we are seeing FDI being as strong as it is. The government in this budget, I mean, I totally agree with Mr. Chidambaram's statement that expenditure to GDP was down. It is at a 40-year low. I mean, I don't have data beyond 1980. I'm sure it is lower than that as well. I think it was an acknowledgement by the government that they cannot spend more on the things they want to spend on, and they do not want to spend on things that they can spend on. So I'll elaborate on that. They cannot build more national highways by giving more money. The NHAI has 70,000 crores of tax-free bonds that they can issue, but they have not issued a single rupee of them. I'm sure many of us, like me, would be waiting for them to be issued so we can invest in them, but they're not issuing any. So the fact that they're not building more roads is nothing to do with lack of money. Same with railways. I mean, railways, I think, are really, really struggling to spend. The government could have spent more on subsidies, but I think they have chosen not to. What this means is that this allows private sector, so the size of the government and the economy continues to shrink. This allows for private sector to get much lower cost funding over time. This requires patience. It's like what my pediatrician does every time we panic with our kid's illness, and he just sends a small message, wait. It's very painful to see the child suffer, but we all know, because the pediatrician knows, it will be all for the good. So I think what we are going through now is, I call a parallel, is redoing the interiors of your house. What India has been struggling with is a vicious cycle of a small government. Contrary to what you and I may believe, the government of India is too small. The New York metropolitan area and the Bangalore municipal area have somewhat similar populations. The New York metropolitan area has 20 times the number of employees of the Bangalore Municipal Corporation. The problem is, if your tax to GDP is too low, like it is in India, it is among the lowest in the world, you cannot have a larger government. And because you don't have a large government, there is inefficiency, there is high informality, and therefore low taxes. It is a vicious circle. You have to break out of this. Demonetization, GST are your steps to break out of it. While you're breaking out of it, it is going to be painful. It's like breaking down the walls of your house, redoing them in a much better way, repainting them in a much better way. While the repainting is happening, it's very painful, but once it is done, 2 or 3 years down the line, I think we'll see a much better economy. One final point on the markets. The Indian market and the Indian economy are not as linked as we think. The Nifty and oil are actually positively correlated. This is something that surprises most people, but it shouldn't. In the last 25 years, there have been long periods of positive correlation, a few periods of no correlation, but almost no period of negative correlation. High oil prices are bad for Indian economy. Low oil prices are good for Indian economy, but not for the Nifty. Nearly half the revenues of the Nifty are not linked to India. And my view for the coming year is that so long as oil does well, I think Nifty should be okay. Within the Nifty is where we can take our discretionary choices, and Prashant and Navneet, I'm sure, will be making them. My own view is that the non-India exposures this year will actually do much better. Maybe I'll leave some time for questions.
Questions from the floor?
I think we'll get questions from the floor now, but as you think of questions, be ready with that. I'll ask one question to Prashant. What is going to be the, is there going to be a reduction in the foreign funds coming into this country as a result of what Donald Trump is trying to do at this moment in time, as also the interest rate that's expected to go up, or that's supposed to go up there? What is going to be the impact?
We have been getting foreign investments in two forms. One is the portfolio investments, either in debt or in equities, and one is the FDI investments. And I think something very interesting is happening in FDI. So India's FDI investments as percentage of GDP, I think, are at lifetime highs. We are at 2%, and when this government came, we were at 1%. And something very interesting again is India's current account deficit is near all-time lows. So our FDI to current account deficit is very, very positive. And that tells you that what the world is thinking about India. Portfolio inflows can come in and go out. And but FIs have been investing in India, I think, now for 25 years. And in all but 3 years, the FI inflows have been positive. So I think, yes, there could be some quarters of turbulence because US interest rates have gone up. They may go up more. But I don't think we should worry about that because India's external side is actually very strong. And last quarter, we saw $11 billion of redemptions on the debt and equity portfolio outflows. It was the highest ever, I think, in a quarter. We redeemed some $20-30 billion of NRI deposits. It was not felt because our external situation, I think, is quite good. One last point here, this government has done a very good job in moderating our gold imports, which were one big reason for our very high current account deficit. And I think as most people have bank accounts, as gold is not doing well. If gold imports remain moderate, I think our CAD will remain low, and even if some investments were not to come in, I think the economy should do reasonably well in such an environment.
On the FPI flows, so I fully agree with Prashant. I think the FDI numbers are at a record high in terms of investment intentions. I mean, greenfield projects started. India is now ahead of China. And I think the reason for that is state governments, because whether we like it or not, 30 out of 31 government employees are state government employees. Beyond the FIPB and maybe some regulatory approvals, if a business or a citizen interacts with the government, interacts with the state governments are making available land banks, they are easing the rules of doing business, easing approvals, giving firm timelines on how long it takes to approve projects. You go state after state. I mean, my state of Jharkhand, where I grew up, I mean, of course, I'm from Bihar, I'm shocked that Raghubar Das is actually doing a roadshow attracting investment. Now, these are structural changes, and I think the foreign companies are taking advantage of that. And I think this is a trend that will continue. Among portfolio investors, I'm surprised that despite all the concerns I have about the Indian economy over the next 12 months, there is a TINA factor. So the medium-term outlook, which I also think is very positive, is continuing to attract. I mean, there is no alternative factor for foreign portfolio investors. It's still very strong. They tell me, okay, so you may be worried about next 12 months, but you tell me which other economy has the prospects that India has over the next 3-5 years. You look at Brazil, you look at China, you look at Russia, I mean, any large-sized economy, and there are structural issues there. And therefore, I think that there is nothing structurally negative about FPI flows. They'll come and go up and down every quarter. But as Prashant said, I think FDI matters more, and that's quite robust.
There's one thing to add, that actually historically so far we have been dancing to the tune of global liquidity, global rate cycle, global risk appetite, because FIs have been so important for our markets. They have been the main investor, the price setter at the margin. But it's changing now. So in last one and a half, 2 years almost, the domestic institutions have been investing much more money in the market than the global investors. Now you have the SIP flows of almost 4,000 crores. You have the PF money, which is another 1,500 crores per month, and the NPS and the other investors. In maybe a few years' time, with the digitalization of finance, which leads to financialization of savings, maybe the domestic pool of savings will provide the much needed stability to the market, and we may not be as dependent or maybe as vulnerable to the global liquidity cycle as we have been historically.
Any question? Yeah, I think
There's one there,
Yeah.
and while the mic goes, I have a question from the floor.
Right.
What are some of the visible impacts of government actions at a reforms level? Pretty generic question, but that's
Prashant,
what's
you
come
want
from
to
the
take
floor.
first, and then I'll ask Navneet after that.
So I think first is the composition of government expenditure is becoming more productive, more on the capital expenditure side, and that's a continuing trend. Subsidies to GDP is going down, tax to GDP is going up. So I think there is sustainable reduction in fiscal deficit. It is a very important reform. I think the government through various initiatives is trying to broaden the tax base, simplify the tax laws. There could be differences of opinion on that, but clearly that's an attempt. And I think over time we should expect moderate levels of taxation, but that should come with a lag. And finally, I think as Neelkant was saying, between the center and the state government, there are a lot of steps being taken to improve the ease of doing business. And one final point, I think the government is using technology to the hilt to improve the delivery and measurability of outcomes and in many social areas like roads, railways, power, education, health. So I think these are some of the areas where we are seeing changes, but India is a very large, complex country, and I think we should be a little more patient. But I feel confident that the direction is right, and we should continue to improve with every passing year.
So if you just add a couple of things that have been done in last couple of years, like the GEM Trinity, the Jan Dhan Yojana, Aadhaar and mobility, the direct benefit transfer. Then you have the reforms in the real estate market with the real estate authority and all that. The changes in the gold market, now the ban on the cash transactions, the more digitalization of finance, all these things with better tax compliance with some of the other changes like the GST reforms and all will lead to a substantial move from the parallel to the mainstream economy, which can increase the tax to GDP very substantially, as you rightly mentioned, and which can also lead to a substantial increase in the domestic savings. The households have huge amount of savings, and I think that can come to the, may get channelized into the financial assets, which reduces our vulnerability on the global flows or the global economy. And some of these things all put together in next couple of years will become visible in showing us that we have become a lot more stable from an overall macro stability point of view. And I think as more savings flow to the market, our ability to invest both by the government and private sector can go up very substantially.
Okay, I've got 3 questions, and I'll direct each one of them to one of the panelists. The first question to Prashant is this, that over the last decade, significant assets were built on leverage. Is the worst behind in terms of high leverage assets? How do you see the trend playing out going forward? The second one is the worst behind in terms of, he assumes that there is high leverage, and he says, is the worst behind in terms of high leverage assets?
So I think what has happened in last 10 years is that for the first time, many capital intensive businesses were opened up to private sector for the first time in India. Power generation, roads, airports, ports. These were traditionally not open to the private sector. And when these were opened up, I think almost all entities or all players have made some or the other mistakes. The entrepreneurs have made mistakes, banks have made mistakes in funding equity out of debt. Regulators have made mistakes, regulations were not very clear. So I think as a result of that, these Excel sheets assumptions have not worked out, and most of these businesses have come to grief. And that is one reason why private capital expenditure is not reviving in the infra space, and government has had to step in to fill the slack. I think the worst to my mind is behind us, because fortunately in India it's a growing economy and the currency has depreciated very sharply. So the replacement cost of all assets, whether it is power plants, roads, ports, airports, has gone up. So I think these companies are very cash poor but reasonably asset rich. So over time I think this leverage will work itself out by some haircuts by banks, by some asset sales. I think the worst is behind to my mind, but we are unlikely to get private capital expenditure in the same areas in a hurry.
Navneet, the question for you is, what is your view on valuations across various asset classes?
So depending on, and after the Nilkant and all the analysts revise their numbers after these results, but roughly around 16 or 17 times forward earnings. If you take a view that last 5 years we had an earning drought, I mean earnings have been growing at single digit, last 2 years have been hardly any earnings growth, but over a longer period the earnings have grown at 14-15%. If we get back to that long run average of 13-14% over the next couple of years, then I think the valuations are reasonable. Since you asked about all asset classes, on the bond side, again the yields have moved up after the budget and the monetary policy, because RBI didn't cut the rate and change the stance. If you ask me structurally next couple of years, the best thing that can happen after this monetary policy and this fiscal direction is that rates can remain at a lower level for an extended period, because you have a central banker who's saying that my main target, my main objective is to bring down inflationary expectations in India. They're so committed towards 4% CPI. Now talking about the core CPI, I think if they are able to remain on that path over a period of time, interest rates should remain lower. Maybe I think rates go up a little bit from here because of the global environment and some of the near-term factors, but structurally rates can remain lower at maybe 7%, 7.5%.
Nilkant, this question is, what is your assessment of the impact of demonetization on the economy and corporate earnings?
It's hard to answer that question in 23 seconds. But I would say that the impact has to be assessed on a longer term perspective. I have seen many investors getting whipsawed on both sides. Again, an analogy I use is a medical one, that, you know, if you put a patient on anesthesia, it's first wrong to fret about the fact that the patient is not talking and walking, and then once the patient comes out of anesthesia, to get overly excited the patient is walking and talking. The period of currency shortages was like the economy being given anesthesia. So by definition, things did get disrupted. I could find, I mean, and apologies to those of you who are vegetarians, but in the wet market, you could find 3 kilo birds, right? 3 kilo chicken. I mean, no one eats 3 kilo chicken, right? The point is that you can't put chicken in cold storage, and they'll keep eating and they'll keep growing big. Which meant that the chicken supply chain was broken, right? And the similar things were happening in utensils, in leather, in vegetables, in a lot of supply chains, as Mr. Chidambaram said, daily wages, construction work. But now that currency is normalizing, I think those are coming right back, right? So all the reverse migration that happened is now coming back. The question to ask is, what is the lasting implication of this? Because, you know, there's no point getting whipsawed about patient being in anesthesia, right? I think there are lasting implications are that, one, people are really worried that this government can do anything. You know, there's something called, I call it a concept of feigned insanity. The North Koreans have perfected it. You know, if people consider you are insane, they take you very seriously. Now, all the kind of harebrained schemes that I see being sent around on WhatsApp, that there will be a cap on gold holdings, that they'll put a camera in front of every locker, that now the 2,000 rupee note is going to get demonetized. Even if it happens, it's not happening this year. But people are starting to believe it. I mean, people who have income to hide are believing, well, if a government can demonetize 85%, they are capable of doing anything. And I think that fear is important. It will be very disruptive for the next 12 months, but I think it will cause this transition to formalization to happen. I think the second point is on real estate. If real estate indeed was the repository of 40% or 40% of real estate demand was coming from the need to deploy black money, the fact that in the next 1 year, no one will, or maybe longer, people will be afraid of buying real estate with black money. Anecdotally, things are changing already, but hopefully as a group, it will not, demand will slow down. Prices come down. See, India is a funny market in the sense that our rental yields are the lowest in the world, which means that the only people buying real estate were people who had to park black money, and people for whom financially it made sense. It never made sense to buy real estate. If real estate prices come down, actually that's great for the economy. The process of coming down is actually going to be very painful, and which is why I'm worried about the next 12 months. But once it has come down, what you want is that no large economy in the world has done well without real estate really kicking up. It creates massive jobs, it creates cement demand, steel demand, downstream demand. And if prices come down and the genuine buyer can afford to buy houses, I think that will be the biggest stimulus that can be given to the economy. So I think both these factors are going to be important. They cause a necessary correction, which is going to be painful, but I think it creates the platform for a much more solid recovery in the next 2-3 years.
I want to end this, but before that I want to put each of them on the spot. I've got 2 questions, one-line answers from them. First is, how do you rate the budget in a scale of 1 to 10, 10 being the highest? And the second one is, what do you expect the Sensex to be at the end of 2017? So Prashant, we'll start with you.
This time we should start.
Okay, we'll start with Nalka. He wants to react after you.
No, I think it would be, I think, an 8 out of 10 for me, because I think the government understood its limitations and tried. As they said, they did no harm, right? Which is, I think, good. The government not doing harm is actually a good government. On the Sensex, we actually, I'm on because of SEBI regulations, if I have not published something, I'm not allowed to comment on it. But if you're taking a 2-3 year view out, I think earnings trajectory of mid-teens is something which is likely, and those should be the kind of returns we should expect from the equity markets as well.
Yeah, Navneet.
So maybe 8 out of 10. On the markets, I think people sitting here, if you have money in bank account earning 6 or 7% and pay 30% tax, I'm sure equity markets will deliver very decent risk premium over and above that. He already talked about the, the prospects about the real estate investing, and same thing can be said about the gold. I think compared to all the other asset classes, I think equities will substantially outperform. That's for sure. It's very difficult to predict where the markets would be next 8 months, but I think over the next couple of years, equity should deliver far better return than most of the other asset classes, even on a risk-adjusted basis.
Yeah, Prashant.
I'm not able to spot any shortcomings in the budget, so I will probably give it a 9. I think equities have lagged nominal GDP growth for 9 years in India. The markets are up 30%, nominal GDP is up between 3 to 4 times. Market cap to GDP is near all-time lows, and interest rates are moving lower. Companies are the biggest borrowers as a group in India. So this 100 lakh crores, the cost of funds, if it drops to 3%, it will lead to massive profit growth for companies. So 1 year targets are hard to put always, but I think in the next few years, the market should grow ahead of nominal GDP growth. So I am quite optimistic in that.
Okay, that's about all that you will get as far as statements are concerned from these people. But I think this has been a very interesting discussion. Of course, the first two speeches that we had with Mr. Chidambaram, whatever the reasons are, whether it is political compulsion or really looking at the macro view, came up with a certain view. Of course, Arvind essentially talked about the current trends with regard to GST. What Arvind said in terms of 4 rates, multiple rates, is what Vijay Kelkar himself has been saying, that it should really come down to 1 rate. And but that is not what we are going to have at this moment in time. And GAR and POEM being the two critical issues that we would face. But the discussion that we had, really what is really going to happen on the ground, and how the corporates are going to be reacting to the issues and so on. And I think there we are getting certainly a more favorable treatment of the budget and also the impact of the budget. Thank you very much.
Sir, your rating of the budget, you haven't given. Your rating of the budget.
My rating of the budget is, I'm going to be slightly lower than what you had, because, essentially looking at the larger purpose and so on, I was going to rate it at 7. But I agree with regard to this performing, the stock market performing better than the GDP growth.
Right. Thank you, panelists. Thank you, Mr. Mahalingam. I now request Mr. Mahalingam to felicitate the panelists.